Right now, while most Americans are watching their stock portfolios and debating whether the Federal Reserve will cut rates again, something unprecedented is unfolding in Canada. A quiet accumulation, a strategic pivot, and according to recent data from industry sources, it represents one of the largest coordinated precious metals stockpiling operations in modern history. Canada, a nation typically associated with polite diplomacy and stable markets, has reportedly increased its silver reserves by approximately 15% through strategic holdings managed by entities like Dundee Precious Metals. But here's what should make you pay attention. They're not alone. India, China, Russia, and other emerging economies are engaged in what market analysts are calling a synchronized buying frenzy. And the metal at the center of this global scramble isn't gold. It's silver. I'm not a financial advisor. This isn't financial advice, and I'm not affiliated with any companies or entities mentioned in this analysis. This is purely educational content based on publicly available market data and historical patterns. But what's happening right now could reshape global commodity markets in ways most people won't understand until it's already too late. Let me show you what the data reveals, and more importantly, let me walk you through why institutions that manage billions of dollars are positioning themselves for what some analysts believe could be a historic price surge to $100 per ounce or higher by 2026. Here's a fact that barely made headlines. In 2024, India's silver imports reportedly dropped by approximately 42%. On the surface, that sounds like declining demand. Bearish signal, right? Wrong. Market observers suggest this wasn't reduced consumption. It was strategic inventory management. India had been accumulating aggressively in prior years. The reported import decline likely indicates they'd already secured substantial physical holdings and were managing existing stockpiles rather than continuing to import at previous rates. Meanwhile, their industrial demand for silver in solar panels, electronics, and manufacturing continued to climb. China tells a similar story. For years, China operated as a net importer of silver, consuming massive quantities for industrial applications. Solar panel production alone in China requires hundreds of millions of ounces annually. But something shifted. Chinese export data from late 2024 and early 2025 showed unusual patterns. Despite being a major consumer, China reportedly began exporting significant quantities of silver to markets like London. Around 660 tons shipped in a single month during this period. That's approximately 21 million ounces leaving Chinese vaults in just 30 days. Why would a nation with surging industrial demand export physical metal? Market analysts suggest two possibilities. Either they secured alternative supplies through strategic partnerships and mining investments, or they were responding to acute shortages in Western markets, where prices and premiums had reached levels that made export profitable even at the cost of domestic availability. Now let's talk about Canada, because this is where the story gets fascinating for American investors. Canada isn't just a neighbor, it's one of the world's most significant silver producers. Canadian mining operations extract millions of ounces annually. Companies operating in British Columbia, Ontario, and Quebec sit on some of the most productive silver deposits in the Western Hemisphere. According to industry reports, Canadian entities, including operations associated with Dundee Precious Metals, have increased strategic silver holdings by approximately 15% in recent periods. This isn't speculative trading. This represents physical accumulation of a metal that Canada literally mines from its own soil. Think about that logic. A nation that produces silver is choosing to stockpile rather than sell into a market where prices have been rising. They're effectively betting that holding physical inventory now will be more valuable than selling at current spot prices. Why would mining interests do this? Because they likely see what's coming. Canada's position is unique. They have direct access to primary production. They understand supply constraints better than almost anyone because they're managing the mines. And if major producers are choosing to hold rather than sell, that typically signals one thing. They believe current prices don't reflect true scarcity. Heraeus Precious Metals, one of the world's leading precious metals refiners and technology groups, released analysis suggesting silver would outperform gold during the 2025 to 2026 period. For context, Heraeus isn't a newsletter writer trying to sell subscriptions. They're an industrial player with over 170 years of experience in precious metals refining and processing. When a company that actually handles physical metal at industrial scale makes a projection like this, market participants tend to pay attention. Their reasoning centers on supply and demand fundamentals. Gold, while valuable and historically significant, doesn't have the same industrial demand profile as silver. Gold's primary uses are jewelry and investment holdings. Silver powers technology. Every solar panel, every electric vehicle, every 5G cell tower, every computer, every medical device. Silver's conductivity properties make it irreplaceable in modern manufacturing. Current forecasts from various market analysts place silver prices at approximately $71 per ounce by January of the coming year. That represents roughly a 22% increase from recent levels around $58. But here's where it gets interesting. If the supply situation deteriorates further, if industrial demand continues accelerating, if investment demand from institutions and retail buyers compounds on top of industrial consumption, some analysts believe $71 could be just a waypoint on the path to $100 or higher by late 2026. The BRICS nations, Brazil, Russia, India, China, and South Africa, along with recent additions and nations expressing interest in joining this economic bloc, represent approximately 45% of the world's population and a growing share of global GDP. These countries have spent years discussing alternatives to dollar-dominated trade systems, and while headlines focus on currency arrangements and payment systems, something else has been happening quietly in commodity markets. Multiple BRICS nations have been accumulating physical precious metals. Russia, facing Western sanctions, has reportedly built substantial gold reserves over the past decade. China's central bank has been a consistent buyer of gold, adding to reserves month after month. India's population has a cultural affinity for precious metals that dates back thousands of years. Now, many of these same nations appear to be extending that accumulation strategy to silver. Why does this matter for Americans? Because when large nations accumulate physical commodities, they remove supply from global markets. And when supply tightens while demand remains constant or increases, prices typically rise. The United States imports a significant percentage of the silver it consumes. Recent government classifications designated silver as a critical mineral, acknowledging its strategic importance for defense, technology, and energy infrastructure. If major producing and consuming nations are stockpiling, and if trade tensions or tariffs disrupt normal supply chains, American industrial users could face higher costs and potential supply constraints. Solar companies, electronics manufacturers, defense contractors, anyone who depends on silver in their production processes would feel the impact. Here's something most people don't realize. Silver isn't primarily mined as a primary product. Approximately 70% of silver production comes as a byproduct of mining other metals, primarily copper, lead, and zinc. This creates an unusual supply dynamic. Silver production doesn't respond to silver prices the way you might expect. If silver prices double but copper prices stay flat, mining companies don't necessarily produce more silver because they're not mining specifically for silver in the first place. This supply inelasticity means that even dramatic price increases may not bring significant new supply to market quickly. New mines take years to develop. Existing mines are already producing at or near capacity. And global ore grades, the concentration of silver in the rock being mined, have reportedly been declining for decades. Miners have to process more material to extract the same amount of metal. Another overlooked fact. Unlike gold, which is primarily recycled and held in vaults where it could theoretically return to the market, silver gets consumed. Industrial applications use silver in quantities too small to make recycling economically viable. The silver in your smartphone, your solar panels, your car's electronics. It's gone, dispersed into products where recovery costs more than the metal's worth. The Silver Institute, an industry association, has reported that global silver demand exceeded supply for 5 consecutive years through 2025. Cumulative deficits over this period reached hundreds of millions of ounces. Where did the metal come from to fill this gap? Existing stockpiles, exchange inventories, government reserves built up during decades of surplus. But those stockpiles aren't infinite, and the data suggests they're depleting faster than most people realize. Shanghai Futures Exchange inventories, which held over 5,000 tons during pandemic peaks, had reportedly declined to approximately 715 tons by late 2025. That's an 86% drawdown. London vaults, traditionally the heart of global precious metals trading, have seen similar patterns, with silver lease rates, the cost to borrow physical metal, reportedly spiking to levels not seen in decades. Let's talk about what market observers believe could unfold over the next 12 to 18 months. This isn't prophecy. It's pattern recognition based on supply data, demand forecasts, and historical precedent. Solar installation globally is projected to continue accelerating. The International Energy Agency forecasts massive renewable energy deployment through 2026 and beyond. Every gigawatt of solar capacity requires roughly 1 million ounces of silver. China alone installed over 250 gigawatts in 2024. Europe, India, and the United States are all ramping up installations. The photovoltaic sector could consume 680 million ounces or more in 2026, potentially representing over 80% of total mining production. Electric vehicle production continues scaling. Silver content per vehicle ranges from 1 to 2 ounces, depending on the model. With global EV sales projected to reach 20 million units or more in 2026, that represents another 20 to 40 million ounces of demand that didn't exist a decade ago. 5G infrastructure build-out requires silver for components, connections, and systems. Artificial intelligence data centers need silver for servers, cooling systems, and power distribution. Medical applications, from antibacterial coatings to specialized equipment, represent steady industrial demand. Add it all up, and industrial consumption alone could exceed 1 billion ounces in 2026. Total global mining production, approximately 800 to 850 million ounces. The math doesn't work without drawing down existing inventories or recycling. And as we've discussed, those inventories are reportedly already depleted, and recycling can't fill the gap. Everything I've outlined so far is industrial demand, consumption where silver gets used and doesn't return to the market. But there's another category that could amplify price movements dramatically: investment demand. When investors, institutions, and funds decide they want exposure to silver, they can move markets quickly because they're competing for the same physical metal that industry needs. In 2020 and 2021, investment demand for silver coins and bars reportedly surged. Mints couldn't keep up. Premiums over spot price exploded. Retail buyers were paying 30%, 40%, sometimes 50% over the official market price just to secure physical metal. And that was before the current supply situation fully developed. If silver breaks through key psychological price levels, $60, then $70, then $80, it could trigger what's known as momentum buying. Investors who have been watching from the sidelines jump in, not wanting to miss the move. Institutions that have been underweight in commodities start adding positions. Hedge funds that model trend-following strategies enter long positions. This investment demand compounds on top of industrial consumption. And unlike industrial users who need silver for production and will pay market prices because they have no choice, investment buyers can amplify volatility. They buy as prices rise, pushing prices higher. They create feedback loops where rising prices attract more buyers, which drives prices higher still. Let's return to Canada's position, because this is crucial for understanding why their stockpiling matters. Canada isn't just holding silver, they're holding an asset they can produce domestically. In a world where supply chains are increasingly viewed through the lens of national security and strategic autonomy, this matters enormously. If global trade tensions escalate, if export restrictions get imposed, if tariffs and barriers disrupt normal commodity flows, Canada sits in an enviable position. They have mines, refining capacity, and strategic reserves. For American industries dependent on silver, Canada represents the closest and most reliable source. The United States and Canada have deeply integrated supply chains and a long history of resource trade. But here's the implication. If Canada is choosing to stockpile rather than export, even as prices rise, it suggests they're anticipating either much higher prices ahead or potential supply restrictions that would make holding inventory strategically valuable. Either scenario has implications for American consumers and industries. Recent discussions in Canadian policy circles have reportedly touched on resource nationalism, the idea that strategic minerals and metals should be managed with national interests in mind, not just market dynamics. If Canada follows the path of other resource-rich nations and implements any form of export management or strategic reserve requirements, it could reduce the supply available to international markets, including the United States. So how does silver get to $100 per ounce by 2026? Let's walk through a plausible scenario based on current data and historical patterns. Current price approximately $58 per ounce. Analysts, like those at Heraeus and various investment banks, are projecting $71 in the near term. That's a roughly 22% move based primarily on recognized supply deficits and continued industrial demand. That gets us to early 2026. From $71 to $100 represents another 41% increase. What would drive that? Several catalysts could combine. First, visible inventory depletion. If exchange stockpiles continue declining and lease rates remain elevated, it signals to the market that physical tightness is real and persistent. Second, industrial supply disruptions. If major manufacturers report difficulties securing silver for production, it validates the shortage narrative and could trigger precautionary buying across industries. Third, investment flows. If silver outperforms gold and equities during the first half of 2026, it attracts capital from investors seeking returns. Large fund inflows into silver ETFs, futures contracts, and physical buying could create significant upward pressure. Fourth, currency concerns. If dollar weakness continues or accelerates, hard assets like precious metals typically benefit as investors seek stores of value. Fifth, geopolitical factors. Any escalation in trade tensions, sanctions, or conflicts that disrupt commodity flows would amplify scarcity concerns. Sixth, mining supply disappointments. If production from major mining regions falls short of forecasts due to operational issues, labor disputes, or permitting delays, it would worsen the supply-demand imbalance. None of these factors alone might push silver to $100, but in combination, with each factor reinforcing the others, you create conditions for a significant price move. Historical precedent shows that commodity markets can move much faster than most people expect when fundamental tightness meets investment momentum. In 1979 to 1980, silver went from approximately $6 per ounce to $48 in just 14 months. That's a 700% increase in barely over a year. In 2010 to 2011, silver rallied from around $17 to nearly $50 in 10 months, roughly a 194% gain. The current setup, with structural supply deficits, surging industrial demand, and potential investment inflows, shares characteristics with both historical episodes. Let's be clear about what we know versus what we're speculating about. The data shows persistent supply deficits. Multiple industry sources, including the Silver Institute, confirm demand has exceeded supply for multiple consecutive years. The data shows inventory drawdowns. Exchange stockpiles in Shanghai, London, and New York have declined substantially from recent peaks. The data shows elevated lease rates, indicating tightness in physical markets. The data shows accelerating industrial demand, particularly from solar and EV sectors that are growing rapidly. The data shows government actions, including the U.S. designation of silver as a critical mineral and reported stockpiling by various nations. These are facts, not predictions. What we're inferring is what these facts mean for prices. Supply deficits eventually lead to higher prices. That's basic economics. Inventory depletion eventually forces market adjustments. Elevated lease rates signal stress in physical markets. Growing industrial demand from technologically critical sectors creates inelastic consumption that persists regardless of price. The question isn't whether these factors exist. The question is when and how dramatically they translate into price movements. And based on historical patterns and current trajectory, many analysts believe that translation could occur in 2026, potentially driving silver toward or above $100 per ounce. For Americans watching this unfold, several implications deserve attention. First, if silver prices rise substantially, it affects costs across multiple industries. Solar installation costs, electronic device prices, automotive manufacturing, all could see input cost pressures that eventually translate to consumer prices. Second, the U.S. imports a significant portion of consumed silver. Supply constraints or trade disruptions could impact American industries more severely than nations with domestic production. Third, U.S. investors have historically played a major role in precious metals markets. American buying can amplify global price trends. Fourth, dollar dynamics matter. Silver is typically priced in dollars, so dollar strength or weakness affects international buying power and demand. The relationship between Canada and the United States in this context becomes strategically important. As neighbors with integrated economies, Canadian resource decisions directly impact American access to materials. If Canadian entities are stockpiling silver while domestic U.S. inventories face their own pressures, it creates a potential supply squeeze for American industrial users. Every major commodity cycle shares certain characteristics. Early stages see supply deficits that develop gradually while prices remain relatively stable. Markets assume the imbalance will resolve through increased production or demand destruction. Inventories buffer the deficit, allowing the system to function without immediate crisis. Middle stages see inventory depletion accelerate. Market participants start recognizing the structural nature of the deficit. Prices begin rising, but most observers still expect normalization. Late stages see inventory exhaustion reach critical levels. Physical tightness becomes undeniable. Prices rise sharply as industrial users compete for limited supply. Investment demand amplifies the move as momentum attracts capital. Premiums over spot prices explode in physical markets. Final stages see prices overshoot fundamental value as panic buying and speculation drive extremes. Eventually, high prices destroy enough demand or incentivize enough new supply that the market rebalances. Prices correct, sometimes dramatically, establishing a new equilibrium at levels higher than where the cycle started, but below the peak. The 2025 to 2026 period appears to be somewhere between middle and late stages based on available data. Inventories are depleted, but not yet exhausted. Prices are rising, but haven't reached levels that would force significant industrial demand destruction. Investment flows are building, but haven't reached the intensity that characterizes late-stage commodity manias. If this cycle follows historical patterns, the most dramatic price movements likely still lie ahead. And the catalysts, Canadian stockpiling, BRICS accumulation, persistent deficits, industrial demand growth, appear to be aligning in ways that could make 2026 a defining year for silver markets. Subscribe to stay updated on this developing story. Drop a comment below and let me know. Are you watching silver markets closely, or is this the first you're hearing about these supply dynamics? Your perspective matters, and I want to know what Americans are thinking as this situation unfolds. Hit that subscribe button right now because what happens next in commodity markets could reshape investment landscapes for the rest of the decade.